Okay, let's unpack this with a question. A question so basic, so intuitive, that its answer really forms the bedrock of, well, all of modern finance valuation and investment strategy. So, imagine you have a choice. It's a guaranteed, totally risk-free choice. Would you prefer to have $50,000 deposited into your account this morning, right now, or would you prefer to receive that exact same $50,000 1 year from today?
Well, unless you know something profoundly disturbing about the future stability of the economy, the answer, for any rational actor, is immediate possession. You take the money now.
Right. Always now. And the why behind that choice, that gut feeling, that intuitive preference for money now, that is the subject of our deep dive today. We are plunging headfirst into the time value of money, or TVM.
TVM is the foundational principle that formalizes this common sense observation. It's the engine driving interest rates, bond pricing, stock valuation,
Mortgages.
nearly every mortgage calculation on the planet. Exactly.
Our sources for this deep dive are, I have to say, surprisingly layered. We're going to start with some ancient legal and philosophical roots, which is fascinating. Then we'll move into the necessary algebra that underpins compound interest.
And then for those of you who really want to see behind the curtain, we're going to push right into the advanced mathematics. We're talking differential equations, integral calculus, the stuff financial engineers use to model risk dynamically.
So our mission is pretty simple. We want you to walk away from this understanding not just that a dollar today is worth more than a dollar tomorrow, but how we prove that mathematically, and maybe more importantly, why that principle is the constant star in the volatile galaxy of global finance.
Exactly. So the core concept summary, the big takeaway if you leave with nothing else. TVM states that there is normally a greater benefit to receiving a sum of money now rather than an identical sum later.
And the reason is simple. Money you have today can be put to work. It can be invested or saved to earn a positive rate of return.
Producing more money tomorrow.
And this is the vital connection to your daily life. This isn't just theory. It's the lens through which you have to weigh the opportunity costs of spending versus saving or investing.
Right. When you save money in a CD or when you lend capital to someone, the interest you are paid is fundamentally compensation. It's payment for the lender's loss of the use of that money during that time period.
It's the cost of deferring gratification.
And that cost is measurable. We could put a number on it.
Okay, so let's start with part one, those historical roots.
To truly get why TVM matters, we have to look past the spreadsheets for a minute and recognize that this concept is rooted in fundamental human psychology. It's about decision-making. TVM is often seen as a direct implication of what economists call time preference.
Time preference. It sounds a little bit like a psychology term, but it's an economic term describing what the preference for present consumption over future consumption.
That's it, exactly. We are, for the most part, wired to value satisfaction right now versus waiting for a similar or even a slightly greater satisfaction later.
I want the cookie now, not 2 cookies tomorrow.
Pretty much. This preference for the present is nearly universal. If you give someone a choice between an immediate small reward and a slightly larger delayed reward, most people, and certainly most economic models, will assume the immediate option is favored. This inherent human impatience has a monetary cost.
And that cost translates directly into the interest rate. So if I'm asking you to suppress your natural preference for spending your money today, I have to offer you some form of compensation.
And that compensation has to cover more than just that psychological cost of waiting. This brings us to the required rate of return. An investor or a lender is willing to forego spending money now only if they expect a favorable net return. And that return has to be high enough to satisfy 3 core requirements.
Okay, what's the first one?
First, as we said, overcoming that natural time preference, the pure cost of waiting.
The impatience factor.
The impatience factor. Second, and this is absolutely critical in modern economies, offsetting inflation. If you loan me $100 today, and in a year, inflation has eroded the purchasing power of that $100 by, say, 3%, you are already behind unless I pay you at least 3% interest.
Right, because my $100 buys fewer groceries next year, so just getting my $100 back means I've actually lost purchasing power.
Exactly. Your capital must at least maintain its purchasing power. And thirdly, in most non-guaranteed scenarios, you have to be compensated for risk. The higher the probability that I won't pay you back, the higher the required rate of return must be to justify giving me the money in the first place.
So it's time preference, inflation, and risk.
That combination, the real risk-free rate, the inflation premium, and the risk premium, sets the required rate of return. That rate, in turn, is the fundamental driver of all the discount rates we are going to discuss today. It serves as the hurdle rate,
The hurdle you have to clear.
the minimum expected return necessary to make an investment worthwhile. If the potential return falls below that required rate, you just keep the money in your pocket.
And while we associate this kind of, rigorous financial modeling with modern banks and hedge funds, our sources highlight this truly fascinating historical thread that shows this thinking is ancient. The concept was explicitly recognized and formalized in law in the Talmud around 500 CE.
Yes, it's a powerful illustration of the practicality of ancient law. The Babylonian Talmud, specifically in Tractate Makos 3a, addresses a very specific legal situation concerning false witnesses in a loan contract.
Okay, let's unpack this scenario. It sounds like a legal drama, but with high finance at its core.
It really is. So imagine a lender provides a sum of money. The contract states the borrower must repay the loan in 10 years, a long-term loan.
Okay.
Now imagine two false witnesses come forward and they swear in court that the loan term was only 30 days. They're lying, obviously, in order to force an immediate repayment, but then they get caught.
So the court has to figure out the penalty. It can't just be a simple fine for lying, because the damage they tried to inflict was purely financial.
Precisely. The court needed to calculate the financial loss that the lender would have suffered if the perjury had succeeded. If the lender were forced to accept repayment in 30 days, rather than waiting the contract to 10 years, what have they lost?
Well, they would have been denied the use of that capital for 9 years and 11 months.
Exactly. The value of that obligation, that debt, changes dramatically based on the time horizon. A 30-day debt obligation is vastly more valuable to the creditor than a 10-year debt obligation, even though the principal repayment amount is identical.
Why more valuable? Break that down.
Because the lender gets their capital back faster.
Right.
That means it can immediately turn around and reinvest it. They regain the opportunity cost sooner. By lying, the witnesses were trying to force the borrower to surrender a less valuable long-term asset
Which is the 10-year term.
for a much more valuable short-term asset, the 30-day term.
So what did the court rule? How did they quantify the punishment?
The court ruled that the false witnesses had to pay the difference in the valuation. They had to figure out what the market value of a 10-year loan was versus a 30-day loan, and the witnesses had to pay that premium. That means 1,500 years ago, judges were performing a calculation that is functionally identical to a modern present value calculation to assess damages.
That is just breathtaking. It proves the core intellectual framework, that time is an explicit factor in monetary valuation, is embedded deep in the history of commerce and law. They knew the value of an asset wasn't just the number on the page, but the use and the reinvestment potential of that sum over time.
Right. And this framework didn't just stop there. As global trade exploded during the Renaissance, the need for more rigorous, universally accepted valuation systems became critical.
And this is where the School of Salamanca comes in.
Yes. The notion was later described in detail by the Spanish theologian and economist Martín de Azpilicueta of the School of Salamanca in the 16th century.
So what was his contribution?
Azpilicueta focused heavily on the concepts of scarcity and demand. He noted that money is worth more when and where it is scarce. This tied directly into time. Money available today, when resources might be scarce or immediate opportunities exist, is inherently worth more than money promised for a future unknown environment.
So he was formalizing the opportunity cost argument.
He was, and this intellectual development really paved the way for the formal algebraic tools that we use today. The need for precise calculation in a rapidly globalizing world demanded that mathematics replace legal precedent.
Which is a perfect transition to part 2, the algebra of time.
So we move from the philosophy of time preference in ancient law to the rigor of modern financial equations. Every single TVM calculation, whether it's simple or incredibly complex, revolves around finding the net value of cash flows at different points in time, and it all relies on 4 key variables.
The universal language of finance, you called it.
It is, you must have. 1, the balance,
Yeah.
which is either your starting lump sum, the present value, or your ending lump sum, the future value.
Okay, PV or FE.
2, the periodic rate, usually written as I or R. This is your rate of interest or your discount rate or your rate of return per period.
The growth engine.
Exactly. 3, the number of periods, N or T. The number of compounding or discounting intervals, years, months, quarters.
How long the money works for.
And 4, cash flows, often written as A or PMT. This represents a series of payments or contributions or withdrawals.
Okay, let's use that simple example again, but this time let's label the variables. If you invest £100
That's your present value, your PV.
for 1 year,
That's N equals 1.
earning 5% interest,
I equals 0.05.
it will be worth 105 after 1 year.
And that's your future value, your FV. That extra £5 is the compensation for deferring your consumption for 1 year.
So that simple scenario reveals the core operation. We're either compounding forward to find a future value or the reverse.
Or discounting backward to find a present value.
Let's focus on that discounting process because this is where valuation really happens. The entire principle allows us to value an asset, say a company or a building, based on the expected stream of future income it's going to generate.
That's right. We take those expected future incomes, we discount each one back to the present, and then we sum them all up. This is the heart of discounted cash flow analysis, or DCF.
So DCF turns a whole series of future promises into a single concrete number today.
A lump sum present value of the entire stream. It tells you what it's worth right now.
Okay, let's look at the absolute kernel of the mathematics, the core formula for calculating the present value, the PV, of a single future value, FV.
This is the simplest form. This formula shows how a future sum, FV, to be received in 1 year is discounted back to today using an interest rate, R. It's simply PV equals FD divided by 1 plus R.
Okay, that makes perfect sense. The denominator, that 1 plus R, is the growth factor. To find what a future amount is worth today, you have to divide by that growth factor. You have to undo the growth.
Now, when we generalize this for multiple periods, N, the power of compounding comes into play. If you're discounting a sum to be received in 10 years, you have to undo the compounding that happened over all 10 of those periods.
You're not just dividing by 1 plus R once.
You're dividing by it 10 times. The foundational equation for the future value, FV, of a present sum shows this compounding in action. It's FV equals PV times 1 plus I to the power of N.
And the inverse of that equation gives us the generalized present value PV formula for a single lump sum received N periods in the future.
Which is PV equals FV divided by 1 plus I to the power of N.
That exponent, that N, that's where the magic happens, isn't it? That is where compounding lives. It's what differentiates simple interest from compound interest.
100%. Simple interest is just calculated on the original principal. Compound interest is calculated on the principal and on all the previously accumulated interest. It's interest earning its own interest.
Can we use a quick example? Let's say $10,000 at 10% for 3 years.
Sure. With simple interest, it's easy. 10% of 10,000 is 1,000. Over 3 years, that's 3,000 in interest. Your total is $13,000.
Okay. Now with compound interest.
Year 1 is the same. You earn 1,000. Your balance is now 11,000. But in year 2, you earn 10% on 11,000. That's $1,100. Your balance is now 12,100.
So you made an extra $100 on last year's interest.
Exactly. And in year 3, you earn 10% on 12,100, which is $1,210. Your final total is $13,310. That extra $310 is the power of compounding.
And that gap gets exponentially wider over time.
It's not just about interest earning interest. It's about geometric growth. When you look at long-term savings or debt, the difference between N equals 10 and N equals 30 is absolutely staggering, because the growth rate is applied not additively, but multiplicatively every single period.
Now, let's talk about the single most critical variable in all of this, the discount rate, that R. We said earlier that an incorrect rate makes the results meaningless. Why is it so hard to determine the right discount rate? What goes into it?
Well, the discount rate is that hurdle rate we discussed. But in practice, it's a subjective dynamic estimate of the appropriate cost of capital for a specific investment. It's not a single number you can just look up.
So it's not just the current interest rate at the bank?
Not at all. For a corporation valuing a new project, for example, they might use something called the weighted average cost of capital, or WACC. That blends the cost of their debt and the cost of their equity.
And for a stock analyst?
They might use the capital asset pricing model, the CAPM, to determine the required rate of return for that specific stock based on its market risk relative to the whole market.
So it's a measure of the risk inherent in the cash flows you're valuing, the opportunity cost available elsewhere, and that time premium we talked about.
Precisely. If you are valuing a guaranteed cash flow from a U.S. Treasury bill, your R is going to be very low. If you're valuing the projected cash flow from a volatile tech startup,
Mm.
R is going to be extremely high, maybe 25% or 30%.
Because the risk of failure is so much higher.
Exactly. The higher the perceived risk or the higher the available return in alternative investments, the higher your discount rate.
And a higher discount rate means?
A lower present value for those future dollars. If I can easily earn 20% of my money somewhere else, I am not going to pay much today for a dollar that only arrives in 5 years. That future dollar gets discounted much more steeply because my opportunity cost is enormous.
So using the wrong rate, say, using 5% when the actual cost of your capital is 10%, could lead to a massive overvaluation. You'd think a project is worth way more than it is.
And you could lose a lot of money.
Right.
Conversely, if you use a rate that is too high, you might incorrectly reject a very profitable investment opportunity. The discount rate is the absolute linchpin of valuation integrity.
Okay, let's move from these single lump sums to the reality of business valuations, which often involve multiple, distinct cash flows happening at different points in time.
Right. To handle this, we use the cumulative present value formula. It simply generalizes that basic PV concept to sum up multiple cash flows, let's call them FV sub T, occurring at different times, T.
So if a project pays me $1,000 in year 1, 2,000 in year 2, and 5,000 in year 3, I can't use one simple formula.
You can't. You have to treat each future cash flow as its own unique lump sum problem. You discount the 1,000 from year 1 back 1 period. You discount the 2,000 from year 2 back 2 periods. You discount the 5,000 from year 3 back 3 periods. And then you add those 3 resulting present values together.
The formula with the big sigma for summation looks intimidating, but that's all it's doing. It's just a systematic way of doing that 3-step process for however many periods you have.
Exactly. The formula collapses all those disparate future promises into a single comprehensive value today. It provides clarity. You can look at a proposal for, say, an infrastructure project that has variable income projections over 50 years and boil that entire complex schedule down to one number. This is what that project is worth today, given our hurdle rate.
Before we move on, we have to revisit a crucial detail you mentioned, which is the cause of so many financial errors. The requirement that the interest rate, I, must always match the period, N.
This is non-negotiable and is where people get tripped up all the time. If you are dealing with an annual interest rate, but your cash flows are happening monthly, you must divide that annual rate by 12.
And then you have to adjust the periods too, right?
And then you multiply the number of periods, N, by 12. If you have a 5-year loan with monthly payments, N isn't 5, it's 60.
A mortgage is the classic example. The bank quotes you an annual percentage rate, an APR, but you make payments monthly.
Right. If you try to calculate the future value of your monthly savings contribution using the annual rate as I and the number of years as N, your calculation will be dramatically wrong.
Why?
Because you failed to account for the fact that you're earning interest and compounding every single month, not just once at the end of the year.
That monthly compounding is powerful.
It is. Let's say you have a 12% annual rate. If you incorrectly use I equals 0.12 and N equals 1 year, your growth factor is 1.1. But if you correctly use I equals 0.01, which is 12% divided by 12, and N equals 12 periods, the factor is 1.01 to the power of 12.
Which it comes out to.
About 1.1268. That 0.68% difference might sound small, but over a 30-year, $500,000 mortgage, that error becomes tens of thousands of dollars. Always match the rate to the period.
Okay, that's a great practical point. Let's move into part 3, applying TVM to these recurring cash streams, starting with annuities.
Moving from single lump sums to the reality of recurring periodic payments brings us to the most practical and frequently used application of TVM.
An annuity.
An annuity. It's the structural basis for practically every recurring financial obligation or asset you can think of. Leases, rent payments, installment loans, retirement withdrawals. Formally, it's a series of equal payments of receipts that occur at evenly spaced intervals.
The equal payment and evenly spaced interval constraints are key, right? That's what lets us simplify the math.
That's what allows the general cumulative PV formula to be simplified into the much cleaner annuity formulas. But first, we need to distinguish between the two fundamental types of annuities.
It all comes down to timing.
It does. The ordinary annuity assumes payments occur at the end of each period. Think of a standard car loan or home mortgage payment. It's due 30 days after the loan is dispersed. Most standard financial models just assume an ordinary annuity unless you specify otherwise.
And the other type is the annuity due.
The annuity due assumes payments or receipts occur at the beginning of each period. The classic example is an apartment rental payment, which is usually due on the first day of the month before you use the space for that month.
So why does that timing distinction matter so much?
Mathematically and financially, a payment you receive at the beginning of a period has one extra compounding period to earn interest compared to a payment received at the end. It's that simple.
So if you're calculating the present value of an annuity due, it will always be higher than the PV of an ordinary annuity.
Always. Because you receive that first payment immediately, it's not discounted at all, and every subsequent payment starts earning interest one period sooner.
So if I'm the one receiving payments, I want an annuity due. If I'm the one making payments, I want an ordinary annuity.
You've got it. The calculation adjustment is incredibly simple. To get the PV or the FV of an annuity due, you just calculate the ordinary annuity value and then multiply it by 1 plus I. That simple multiplication accounts for that one extra period of compounding across the entire stream of payments.
Okay, let's focus on the present value of an annuity, PVA. This tells us the current lump sum cash value of that stream of fixed future payments.
Right. The PVA formula, while it looks complex, is really just a mathematical shortcut. Instead of running the cumulative PD formula from part 2 over and over again and adding them all up, the PVA formula uses the characteristics of a geometric series to collapse that long calculation into one single expression.
And this is what loan servicers use to figure out how much principal is left on my car loan or my mortgage at any given time.
Exactly. The future value of an annuity, FEA, is just as important, especially for our listeners thinking about long-term savings or retirement.
This one is about building wealth, not valuing a debt.
Yes. The FEA calculates the accumulated value of a stream of regular contributions after end periods, assuming those payments are consistently invested at a rateation. This is the power of dollar-cost averaging and compounding over decades. For most people, this is the most powerful formula they'll ever encounter because it shows the true wealth-building potential of regular, disciplined saving.
But the real world is rarely static. Payments aren't always fixed. What if they're designed to increase over time? This brings us to the growing annuity.
This is a scenario that perfectly matches reality. For instance, when you're planning for a long-term pension, you should probably assume your annual contributions will increase by a certain percentage as your salary increases over your career.
Or in real estate, a commercial lease might have an annual contractual rent escalator indexed to inflation or some fixed rate.
Perfect example. So, in a growing annuity, each successive cash flow grows by a factor of 1 plus G, where G is that expected growth rate.
And this must make the math a lot harder.
It adds a significant layer of mathematical complexity. It forces the analyst to use two different specialized formulas for the present value, depending on whether the growth rate, G, is equal to the interest rate, I, or not. Most standard financial calculators can't handle this. It requires a deeper understanding of the underlying math.
It really highlights that the moment you introduce variability, you leave simple spreadsheet arithmetic behind, and you enter the domain of true financial modeling.
Now let's go beyond the finite and discuss the theoretical ultimate expression of TVM, the concept of forever, the perpetuity.
A perpetuity is defined as an infinite and constant stream of identical cash flows. This seems like a paradox. How can you possibly calculate the current value of something that lasts forever? Wouldn't it be infinite?
It seems like it should be, but the key is that the math simplifies dramatically, precisely because we introduce infinity. We derive the perpetuity formula by taking that PVA formula and allowing the number of periods, n, to approach infinity.
Okay, talk us through the mathematical insight there. In the PVA formula, there's a term, 1 divided by 1 plus I to the power of n. That represents the discounting of the final payment.
Right. And as n, the number of periods, gets larger and larger approaching infinity, that denominator, 1 plus I to the n, grows infinitely large.
And when you divide 1 by an infinitely large number, the result gets closer and closer to
0. The present value of any payment made in the extremely distant future essentially vanishes. It becomes mathematically irrelevant to its value today.
So the value of a payment I'm supposed to receive 500 years from now is so heavily discounted that it's basically worthless today. We don't even need to account for it.
Precisely. The effect of discounting overcomes the infinitude of time. This simplification causes major parts of the PVA formula to cancel out, leaving us with this elegantly simple calculation for the present value of a perpetuity, PVP.
And what is that formula?
It's just PV equals A divided by I, the payment amount divided by the interest rate.
That's wonderfully clean. So if you want to receive a fixed payment of, say, $1,000 a year indefinitely, and the interest rate is 5%, you just divide 1,000 by
And
0.05.
you get $20,000. That formula tells you the exact lump sum you need to invest today at rate I to generate that stream of returns forever without ever touching the principal.
Where is this used in the real world?
It's used to value specific assets, like preferred stock, which often pays a set dividend indefinitely, or certain old government bonds called consols.
But just as with annuities, we have to account for growth, and this leads to the very powerful growing perpetuity.
This is a perpetual annuity where the payment grows at a fixed rate, G, forever. This formula is absolutely crucial because it attempts to model businesses that are expected to exist indefinitely and generate perpetually increasing cash flows, maybe slightly outpacing inflation.
There's a critical condition for this formula to work, though, right? For it to give a rational economic result.
Yes, and this is non-negotiable. The growth rate, G, must be strictly less than the discount rate, I.
What happens if it's not? What if G is bigger than I?
If the expected growth rate of the payments were equal to or higher than your required discount rate, the resulting present value would be infinite or negative. It would mean the asset is too valuable to quantify a mathematical impossibility under stable economic conditions. It basically means the payments are growing faster than you can discount them.
Okay, so assuming that rational condition G is less than I holds, the resulting formula is perhaps the single most famous valuation equation in equity markets.
It is. It's PV equals A divided by I minus G,
And that is the Gordon growth model.
also known as the dividend discount model.
Let's spend a moment on this one because this is the perfect illustration of TVM moving from theory into practical high-stakes valuation. How exactly is it used to value a stock?
Okay, so in stock valuation, the A represents the company's expected dividend payment 1 year from now. The I is the investor's required rate of return for that stock, which is based on its risk. And the G is the expected long-term stable growth rate of those dividends into perpetuity.
And the result of that simple division tells you.
The intrinsic value of the stock. It's the maximum price you should be willing to pay for that stock today, based on those assumptions. It's the intellectual framework for a huge amount of equity research.
Well, what makes it so challenging to use in practice? It seems so simple.
It's powerful, but it's highly sensitive to its inputs. First, that required rate of return, I, is just an estimate based on risk. Second, estimating a sustainable perpetual growth rate, G, is notoriously difficult. Analysts often anchor this to the long-term expected rate of inflation or GDP growth, but even a tiny error, say 2% versus 2.5%, gets magnified because G is in the denominator.
And third, I assume it only works for certain kinds of companies.
Absolutely. It assumes the company will exist forever and pay a stable, growing dividend. That immediately excludes most high-growth tech companies that are reinvesting all of their earnings and don't pay a dividend. It's best suited for stable, mature, dividend-paying companies like utilities or consumer staples.
Powerful, but you have to be very careful with your assumptions.
You do. Now let's synthesize all these applications with a classic example. Coupon bond pricing. This is where we combine the two major calculation types we've just covered.
So when you buy a coupon bond, you're essentially buying two distinct financial assets bundled into one security.
That's a perfect way to put it. A coupon bond provides two types of cash flows over its life. First, you get the stream of periodic coupon payments. These are fixed, regular payments.
So that part is just an annuity.
Precisely. That part is treated as an ordinary annuity. You calculate the present value of that entire stream of coupons using the PVA formula.
And second, at the very end, when the bond matures, the investor receives the large lump sum return of capital, the face value or par value of the bond.
And that single large final payment is treated as a simple future value lump sum. You discount it back to the present using the PV formula from Part 2.
So to get the bond's current price, its market value, you calculate the PV of the annuity of coupons, you calculate the PV of the final lump sum, and you just add them together.
That's all there is to it. It highlights the elegance of TVM. No matter how complex a financial instrument seems, if you can just break down its cash flows into periodic streams and lump sums, you can determine its current market value.
That synthesis is really the professional application of everything we've covered so far. But now we transition from the application of algebra to the rigorous tools of calculus.
Yes, which are essential for modeling risk and dynamic market conditions.
Okay, part 4, advanced mathematical framing. We are now putting on the financial engineering hat, moving beyond fixed periodic calculations into the realm of constant dynamic change. This starts with continuous compounding.
Most people are familiar with discrete compounding, daily, monthly, or quarterly. Continuous compounding is the theoretical limit of that. It's what happens when the rate is compounded infinitely many times over a given period. It's the ultimate smoothing of the growth curve.
But if the difference between annual and daily compounding is already pretty small, why do we bother with this conceptual leap to infinite continuous compounding?
The primary reason is, honestly, mathematical convenience. When you use discrete compounding, the resulting formulas are chunky. They have exponents. They're difficult to manipulate using calculus. By converting rates into the continuous compound interest rate equivalent, we get a smooth, differentiable function.
And that makes it easier to model.
Much easier to work with when you're modeling complex derivatives or developing hedging strategies.
And this is where the base of the natural logarithm e, that famous transcendental number, makes its appearance.
Exactly. The present value of a future payment, FV, at time skete using the continuously compounded rate R, is given by a new formula. PV equals FV times e to the power of negative ert.
That expression, e to the negative art, is known as the continuous discount factor. It replaces the discrete discount factor of 1 over 1 plus r to the t.
Right. And while computationally it's very close to daily compounding, its real value lies in how neatly it integrates into higher-level mathematical structures. It allows analysts to perform instantaneous calculations of sensitivity and change.
And this framework is essential when we consider the reality of varying discount rates. As we established, the discount rate R should ideally account for changing market conditions and risk over time. It's not a constant.
Right. If your required rate of return is not constant, if you expect low risk and a 5% return for the first 2 years, but then high risk and a 15% return for the following 3 years, you can't just plug a single R into the simple formula.
So what do you do?
Instead of a constant rate R, we use a time-dependent function R, T. To calculate the present value of a sum under this varying rate environment, we have to integrate the continuously compounded rate over the entire period.
Okay, so integration, in this context, is the mathematical tool for summing up the effect of an infinite number of instantaneous discount factors along that timeline.
You got it. The resulting formula involves the exponential of a negative integral, which looks terrifying, but conceptually, all it's saying is, calculate the total cumulative discount factor generated by the changing rate from today times 0 to the maturity time, t.
It's powerful because it allows for dynamic valuation. If the market suddenly changes its risk assessment, the function RD updates, and the system can instantly recalculate the new present value.
It does. And the source material provides the continuous equivalence for all our Part 3 concepts, annuities, perpetuities, growing annuities. This just shows that the conceptual structure of finance is robust. We're simply swapping the mathematical language from algebra to calculus for more precision and flexibility.
But the highest level of conceptual sophistication is framing TVM through differential equations. This is the ultimate conceptual leap in modern finance.
It really is.
So let's clarify what we mean by a conceptual leap here. In parts 2 and 3, we were always calculating a single number, the PV today. What does the differential equation approach calculate instead?
It shifts the focus from a single static snapshot, a number, to a dynamic function. When we use ordinary differential equations, or ODEs, we are calculating VT, which is the present value of the asset at any point in the future, T, not just at time 0.
So we're modeling how the value evolves or decays over time. This makes sense because the value of an asset that doesn't generate income for 5 years is constantly increasing in value toward its future cash flow as the discounting time shrinks.
Correct. The core statement of TVM, that value decreases as time passes, assuming no cash flows occur, is formally defined by something called a linear differential operator.
Yeah.
That minus sign on the partial derivative with respect to time mathematically encodes that decrease in value. The other term represents the loss of value due to the foregone opportunity cost of the investment.
So if the value function, VT, were to change, say, because of an unexpected payment, the differential equation would immediately model that shock to the system.
And that allows analysts to study the sensitivity and the evolution of the asset's value dynamically, in real time. And the standard tool used in physics and math to solve these ODEs is called Green's functions.
That sounds dense. Let's find an analogy. What does the Green's function represent in financial terms?
Think of it as the atomic structure of cash flow. In finance, the Green's function for TVM is defined as the value of an asset that pays exactly $1 at a single instantaneous point in time. This instantaneous, isolated cash flow is modeled mathematically as a direct delta function. which is just a fancy way of saying a single spike at a specific point on the timeline.
So it's the basic unit of value, the value today of $1 paid tomorrow and nothing else.
Exactly. The Green's function gives you the value of that single instant event. And the profound so what here is that any complex financial instrument, any combination of coupons, maturities, fees, or dividends can be modeled as an infinite series of these instantaneous cash flows.
And since Green's functions are the solution to the differential equation for that one instantaneous event,
By integrating all those Green's functions together, you can build the value of the whole complex cash flow stream.
this is the foundation of the really complex stuff.
This sophisticated methodology, using differential equations and Green's functions, is the very foundation upon which complex derivatives pricing models are built. When you hear about the Black-Scholes formula or models for interest rate swaps, you are hearing about mathematical structures that are ultimately solving differential equations, where TVM is the core operator.
Wow. We started with a judge in 500 CE determining the financial difference between a 30-day debt and a 10-year debt. And we have ended this dive with the instantaneous discounting of future cash flows using calculus to price billion-dollar derivatives. That conceptual path is truly incredible.
The logic never changed. We just got better tools to measure it.
Okay, let's wrap this up. We've covered a tremendous amount of ground today, tracking the concept of time and money from its roots in ancient law all the way to its application in Wall Street valuation models.
And the core logic, as I said, never changed. We simply formalized it. We established that the critical variables remain constant across all levels of complexity: present value, PV, future value, FV, the rate, I or R, and the time, N or T.
Whether you're calculating a simple savings goal using basic algebra or dynamically modeling asset risk using differential equations, you are fundamentally just asking how those four variables interact under compounding and discounting.
And now you have the conceptual toolkit. You understand the necessity of time preference, the crucial role of determining the correct discount rate, the practical application of annuities in mortgages and bonds, and why financial engineers turn to calculus when they need maximum precision and flexibility in dynamic markets.
Every time you open a savings account or consider paying down a mortgage early or evaluate a business investment, you are engaging in a TVM calculation. You are measuring the opportunity cost of having or not having that capital today versus tomorrow.
You are.
So here's a final provocative thought, something that builds directly on the deepest assumption of everything we've talked about today. The entire structure of TVM, all the formulas, all the compounding, all the valuation, hinges on the certainty that money today can be invested to earn a sustained positive rate of return.
Right. That assumption dictates that the discount factor, 1 over 1 plus r to the n, must always be less than 1, which means future money is worth less.
But imagine a sustained, guaranteed economic environment where the expected rate of return on all capital was structurally negative. Not just temporarily negative in inflation-adjusted terms, but fundamentally numerically negative.
So money actively shrinks just by holding it.
Exactly. If that happened, the value of a dollar today would be mathematically less than the value of the same dollar in the future. The fundamental time preference for present consumption would be economically penalized.
It would completely reverse the logic. A dollar tomorrow would be worth more than a dollar today.
If capital actively decayed in value just sitting in the bank, what would that force us to do with our resources? Would that accelerate consumption to prevent decay, or would it fundamentally destroy the incentive to save and invest for the future?
It completely reverses the gravitational pull of time on money. And the mathematics of TVM is the only tool robust enough to map what that strange new economy would look like. It's a profound question to ponder on your next deep dive.